Since the year 2000, the US government has been racking up debt like it's going out of style. In fact, the national debt has ballooned by 530%, jumping from $5.7 trillion to a whopping $36 trillion today. But as the debt has soared, so has the price of gold, which has skyrocketed by 880%, leaping from $280 to around $2,750 per ounce. Gold tends to shine brightest when people worry about rising debt and economic uncertainty, making it a popular safety net in shaky financial times. How fast are they growing? Let's break it down a little more. Debt has grown at about 8% per year since 2000, and gold has gone up by about 10% each year. This shows that gold is like the sprinter of the two, outpacing debt over time. It's a solid performer when the government's borrowing spree feels out of control. How gold reacts to debt. Here's the interesting part. As we have proven earlier, over the long term on an annual basis, gold has increased by 25% more than the percentage increase in US national debt. So when the government borrows more money, investors start buying gold to protect themselves, pushing the price up even more. It's like gold is saying, "Don't worry, I've got your back." What's happening now and what's coming? Right now, the US is adding a minimum of $1 trillion to the national debt every 100 days. This means that the next 100 days, the debt grows by 2.8%, which based on the historical gold-to-debt ratio of 1.25 means gold prices could increase by about 3.5% for every 2.8% increase in debt. Projections: 6 months. In the next 6 months, or about 1.8 cycles of 100 days, the debt should increase by 5%. Using the 1.25x ratio, gold should rise by 6%. Starting from the current rounded gold price of $2,750, this would bring gold to approximately $2,900. Over 1 year, the debt should rise by 10%, pushing gold prices up by about 13%. That would place gold at approximately $3,100 in 1 year, 5 years. If the US keeps adding debt at the current rate, it should see at least $18.25 trillion more debt over 5 years. This would result in a 50% increase in debt, and applying the same gold-to-debt ratio, gold could rise by approximately 88%, leading to a price of $5,170 in 5 years. Conclusion: debt and gold are locked in a dance, and right now it looks like gold is leading. As the US piles on more debt, gold will likely keep rising, protecting investors from the risks of that growing national debt. If things keep going the way they are, we could see gold hit new highs in the next year, and it could go much higher in the next 5. And here's one more interesting fact to leave you with. In bull markets, silver tends to move 2 to 3 times as much as gold. So, while we've projected where gold might be in the next 6 months to 5 years, we'll leave it to your imagination to consider just how high silver could soar.